So a little market update today. Rates are at 24-year highs, and all of it's due to the pressure from the debt. We have a lot of debt going on. We have to sell a lot of treasury bonds. And when you have to sell that, people will only buy if they're making good money. So that's why there's a lot of pressure on rates. It's because of the debt. And there was a strong job number today. So that's leading the Fed to kind of just either do one more rate hike or hold and see how things play out. But right now, the economic data has been strong. Like the jobs reports were strong, labor wages are strong. So we're not going to see these tremendous rate cuts like people were saying at the end of 2023 or beginning of 2024. The experts were saying, hey, this should happen. It's being like the weatherman. I'm being honest. Like when people say, why don't you know what's going to happen? There's so many outlying factors that affect mortgage rates. But if you're buying now, there's more inventory right now, there's less competition, and once the rates go back down, you can always refinance. So definitely get off your seat, get out there, take a look at what's going on. A lot more sellers are willing to give credits. If you're a first-time buyer, there's some special programs with discounted rates. So while things are, really tight right now, let's hope in the next couple months that some new readings and new reports come out and that inflation holds steady, because that's going to be the driver of the mortgage rates.